The importance of FDI in Ireland is clear. Over 50% of employment taxes and over 80% of corporation taxes in Ireland are paid by foreign multinationals. The budget historically does not have many measures which would impact on FDI. We would generally see that detail later in the finance bill. The international tax environment is going through a fundamental change. We have the new Pillar 2 minimum tax rules introducing a 15% tax rate. This means the Irish 12.5% is less attractive. We are certainly now seeing changes in the international landscape, and there are more incentives and subsidies being introduced. It's also important to bear in mind what's happening in the US. There will be a US presidential election later this year. The US tax rate is currently 21%, naturally much higher than the Irish tax rate. However, the Trump administration are proposing that they would reduce the tax rate closer to 15%. On the other hand, the Harris team are proposing they would increase it closer to 28%. These two proposals could have a fundamental impact on future FDI in Ireland. KPMG's budget submission focused on two key themes: competitiveness and simplification. It's important that Ireland remains competitive in order to remain a home for foreign direct investment. We have made a number of suggestions in this regard, which include increasing the R&D tax credit to at least 35% and up to 50% for investment in new green technology. We also suggest that there are changes to the taxation of leasing to ensure that Ireland remains a key leasing hub worldwide. We also suggest that there are enhancements to the employment tax regime. This would include reducing the level of employment taxes, changes to taxation of share-based remuneration, and enhancing SARP. SARP is a very important regime in Ireland in order to attract and retain key foreign talent. When it comes to a territorial regime on foreign dividends, we have long advocated for a new regime in Ireland, as Ireland has remained an outlier in the EU as one of the only countries that taxes foreign dividends. Thankfully, it looks like a new regime will be introduced this year as part of the budget, which will exempt certain foreign dividends. KPMG has suggested that this would apply broadly and automatically, and also it's expected that a similar exemption for branch income will be introduced next year. We also believe it's important to reduce the cost of doing business and reduce the administrative burden on businesses in Ireland. In this regard, KPMG's submission has made a number of recommendations in order to simplify Irish tax law. This would include removing obsolete tax legislation. It would include allowing taxpayers to file a consolidated corporation tax return like they can with VAT, and also a long-awaited review of Ireland's increasingly complicated interest deductibility rules. In this regard, it is welcome that the Department of Finance have committed to undertaking a review of interest deductibility rules later this year.